We all use banks, right? For our savings, our payments, our mortgages. But have you ever stopped to think, what does a bank actually do? And more importantly, how do they make their money? It's not just from your account fees. Today, we're breaking down the 4 core activities of a bank. Let's dive in. The first and most classic activity is called transformation, or to put it simply, borrowing and lending money. When you deposit money in a bank, the bank pays you interest. For the bank, this money is a liability because the bank is essentially buying money from you. Then they sell that money by lending it out as business loans, mortgages, or study loans to earn interest. These loans are the bank's assets because they generate income. Their profit here is the gap between the interest they receive and the interest they pay, which is called the margin, and it is influenced by competition, the economy, and central bank policies. Another core activity of banks is called intermediation. Here, banks aren't lending their own money. Instead, they use their expertise, networks, and trust to provide services for a fee. Think of them as financial concierges or architects. Let's break it down. First is brokerage. You want to buy stocks or foreign currency? Banks are the access point to the market. They execute the trade for you. Their income here is a commission or a small markup on the price. Then there's asset management. Here, the bank manages investment portfolios or funds for clients, aiming to achieve higher returns. In return, the bank charges a fixed management fee and sometimes an additional performance or success fee if results are strong. Banks are also heavily involved in investment banking. Companies often raise money by issuing tradable securities such as shares or bonds. Here, the bank advises the company, structures the transaction, and helps sell these securities to investors. In some cases, the bank may underwrite the transaction. This means the bank buys part or all of the securities first and then resells them to investors. Another important intermediation service is custody. Here, the bank safeguards financial assets like shares or bonds for individuals or companies. They also handles administration, settlement, and the collection of interest or dividend payments. So what do banks earn from all this? For intermediation activities, banks do not earn interest. Instead, they earn fees, commissions, and service charges. In short, intermediation is all about expertise, access, and trust, with the bank acting as the link between clients and the financial markets. Activity 3 is so seamless that we often forget it's even there. Payments. We use payment services every day, which makes it easy to overlook just how important banks are in this process. Efficient payment systems are essential for economic development and growth. Imagine the economy as a giant, complex machine. For all the parts, workers, factories, stores, websites to work together, they need a lubricant. Money is that lubricant. But money has to move. That's where payments come in. Every payment from your salary hitting your account to you buying a textbook is a transfer of that economic lubricant. Without an efficient payment system, the machine seizes up. Trade stops, salaries stall, and economic growth grinds to a halt. So who builds and maintains the pipes and pumps for this flow of money? Largely banks. Now, the tools we use to make payments have evolved massively. On the consumer side, it's pretty straightforward. The classics, cash, checks, and cards. And now the modern favorites, internet payments, mobile wallets, and peer-to-peer apps. Simple for us, but behind each one is a digital handshake between banks. For corporations, it's a whole different league. Their needs are far more complex, like cash pooling, where a large company needs to gather money from hundreds of stores, automatic collections for thousands of customer subscriptions, paying hundreds of suppliers electronically. And the big one, international or cross-border payments, which involve multiple currencies, regulations, and banking systems across different time zones. This is where banks provide serious, heavy-duty financial plumbing. So how do banks profit from payments? The obvious way is through fees and service charges for processing transactions. There is also a clever, lesser-known source of income called interest on float. Here's how it works. Let's say you pay a bill online on Monday. Your bank debits your account immediately, but they might not actually send that money to the utility company's bank until Tuesday. For that one day, that money is still in the banking system. Banks pool together millions of these in-transit money and can invest them overnight, keeping the interest earned. It's a tiny profit on each transaction, but at massive scale, it used to be hugely profitable. However, with the move toward faster and near-instant payments, this source of income is gradually shrinking. The final core activity is proprietary trading. This is where the bank stops being a middleman and becomes a player, trading in financial markets with its own money to make a profit. It's a potentially huge but very risky source of income, so many banks limit this activity. There are two key approaches. First is speculation. If a trader expects the price of a share to increase, the trader buys the share. This is called a long position. The risk is that the price may fall instead, leading to a loss. This type of risk is known as market risk. Instead of buying an asset, a trader can also sell an asset while expecting its price to fall. This is known as a short position. It involves selling a borrowed asset, hoping to buy it back later at a lower price. Another form of trading is market making. Here, the bank continuously buys and sells financial assets to profit from the spread, which is the difference between the buying price and the selling price. This activity provides liquidity to financial markets and is different from speculation. Investment banks and hedge funds are typically more focused on proprietary trading than traditional retail banking. So, there you have it. The modern bank is not a one-trick pony. It's a complex institution that transforms money through lending, intermediates for fees, facilitates payments, and sometimes trades on its own account. Together, these activities form the foundation of modern banking and support the global financial system. I hope this video explained their revenue sources, their risks, and their role in your life. What activity surprised you the most? Let me know in the comments below. If you found this video helpful, please give the video a like and subscribe for more finance-related topics. Thanks for watching, and see you in the next one.